A self-storage facility may be the simplest looking business you can buy. There is no kitchen, no product has to be manufactured. The customer brings the inventory, locks it behind a metal door, and pays every month for the privilege of leaving it there. Compared with apartments, there is not even a tenant living inside the space, waiting to call because a sink stopped working at midnight. From the road, the business can look almost passive. A gate, a fence, rows of boxes, recurring rent. But imagine you are the owner on opening morning. The buildings are finished, the asphalt is down, the cameras work, the keypad works, the doors roll up and down exactly as they should, and most of those doors are empty. That matters because an empty storage unit does not become cheap just because nobody rented it. The land is still there. The property taxes are still there. Insurance is still there. Security, maintenance, marketing, and financing are still there. The physical asset may be complete while the business is nowhere close to finished. So the interesting question is not whether storage can make money. Clearly, some storage properties make a great deal of money. The question is why one ordinary-looking facility can become an extremely efficient income-producing real estate asset, while another facility that looks almost identical can spend years struggling to justify the money tied up in it. To answer that, we are going to follow one facility all the way through the numbers. Picture a representative American self-storage property with 50,000 net rentable square feet. That means 50,000 square feet of actual space the owner can rent to customers. For our model, assume the total capital tied up in buying or developing the property is $7.5 million. Assume $4.5 million of that is debt. Those numbers are illustrative. They are not being presented as a national average, a quote for construction, or a recommended deal structure. They are simply a clean way to keep the same property in view while we change one variable at a time. Because once you do that, self-storage stops looking like rows of boxes and starts looking like a machine. And the first thing that machine needs is time. Before you know what the facility will ultimately earn, a large part of the owner's decision has already been made. The site is chosen, capital is committed, the property is bought or developed. The owner has accepted a particular location, a particular amount of rentable space, a particular financing structure, and a particular set of local rules. That last part matters more than the simplicity of the building might suggest. A self-storage operator can be exposed to zoning changes, property taxes, consumer protection rules, and local restrictions that affect pricing or lien procedures. Large operators such as Extra Space Storage explicitly list local competition, new development, zoning, taxes, and regulation among the things that can affect occupancy, rent, and expenses. For our representative owner, none of that means the facility is a bad idea. It means the first meaningful business decision happens before the first monthly rent payment arrives. The owner is not merely choosing how many metal doors to install. The owner is choosing a local demand pocket and then attaching capital to it. Our model property has 50,000 rentable square feet. Assume $7.5 million of total capital and $4.5 million of debt. The remaining capital is equity. Again, those are illustrative inputs, not typical figures. Now imagine the owner has finished the project. At that moment, there is a strange asymmetry. The cost side is already very real. The revenue side is still hypothetical. A building can be delivered on a date. Stabilized demand cannot. The owner can inspect the roof, test the gate, count the cameras, and know exactly how many square feet exist. But the owner cannot force households and small businesses within the trade area to rent those square feet at the price the original model assumed. And that creates the first race in the business. The facility is open, the debt exists, the property has expenses, but the rent roll has to be built customer by customer. The industry has a word for this period: lease-up. It is the time between opening a property and reaching a level of occupancy and income that can reasonably be called stabilized. There is no universal lease-up clock. It would be misleading to say every facility takes 18 months, 2 years, or 3 years. Markets differ, competition differs, unit mix differs, pricing differs. But the risk is real enough that large operators separate it in their own reporting. Extra Space Storage says that a class of newly completed stores can require roughly 2 to 4 years to lease up. That is a company-specific observation, not a universal rule, but it tells you something important. Even a sophisticated operator does not treat a finished building as a finished income stream. Extra Space also has a specific way of deciding when properties enter its stabilized same-store pool. Public Storage, likewise, reports a large group of acquisition, development, and expansion properties separately while they are in various stages of lease-up. At the end of 2025, Public Storage said that group included hundreds of facilities and more than 50 million rentable square feet. The lesson for our owner is not that their facility will behave exactly like either company. The lesson is simpler. Professionals distinguish the physical property from the stabilized business because they are not the same thing. So let us make lease-up visible in our illustrative facility. Assume the property eventually reaches 90% occupancy at an effective annual rent of $20 per occupied square foot. But it does not begin there. In our model, year 1 averages 35% occupancy and $16 of effective annual rent per occupied square foot. 35% of 50,000 square feet is 17,500 occupied square feet. At $16 per occupied square foot for the year, that produces about $280,000 of rental revenue. Assume the property operating expenses in this simplified model are $300,000 a year. That means the property itself is about $20,000 negative before we even talk about debt service. The doors exist. The owner can walk past all 50,000 rentable square feet. But most of the income-producing capacity is idle. Now move to year 2. Assume occupancy averages 65% and effective annual rent reaches $18 per occupied square foot. Rental revenue rises to about $585,000. Subtract the same illustrative $300,000 of property operating expenses, and the property generates about $285,000 of net operating income. That is progress. But remember, the debt has not been politely waiting for stabilization. Then, in year 3 of our illustration, occupancy reaches 90% and effective annual rent reaches $20 per occupied square foot. Rental revenue reaches $900,000. After $300,000 of operating expenses, net operating income reaches $600,000. The building did not suddenly become better steel in year 3. The gate did not become more valuable because it had aged. What changed was the income attached to the space. That is why lease-up is such an important owner problem. The owner commits capital first and discovers the stabilized rent roll later. And it creates a tempting conclusion. If empty space is dangerous, the obvious goal must be to fill every unit as quickly as possible. That sounds right until you ask one more question. Full at what price? Suppose our 50,000 square foot facility is 95% occupied. That looks excellent from the parking lot. Almost every door has a customer behind it. But assume the effective annual rent is only $17 per occupied square foot. 95% occupancy gives us 47,500 occupied square feet. Multiply that by $17, and annual rental revenue is about $807,500. Now compare that with the same property at only 90% occupancy, but at $20 of effective annual rent. 45,000 occupied square feet times $20 produces $900,000 of annual rental revenue. The less full facility produces more rent. That does not mean 90% occupancy is always better than 95%. It means occupancy is only one part of the answer. Physical occupancy tells you how much space is occupied. It does not, by itself, tell you the economic quality of that occupancy. A beginner can look down a corridor, see almost no empty units, and conclude that the business is working. The owner has to ask a different question. How much effective revenue is actually attached to those occupied units after promotions, discounts, bad debt, and the mix of rents being paid by different customers? This is where self-storage starts behaving less like a vending machine and more like a local pricing system. Because the rent a new customer sees today is not necessarily the same thing as the rent the property is actually realizing across its occupied space. Imagine searching for a storage unit online. You see an advertised rate. Maybe there is a promotion attached to it. That price has one job: convince a new customer to choose this facility instead of another one nearby. But the owner is managing a building full of customers who moved in at different times, under different offers, and at different in-place rents. That creates at least two pricing realities. There is the price being offered to win the next move-in, and there is the effective rent being collected across the customers already occupying the property. A useful real-world example comes from Extra Space Storage's 2025 reporting. In its same-store portfolio, the company reported average annual rent per occupied square foot, net of discounts and bad debt, of $19.91. Its average rent on new leases was much lower, at $13.16 per square foot. It also reported discounts equal to a little over 2% of rental revenue. Those numbers belong to Extra Space's portfolio. They are not national averages, and they are not the assumptions in our representative facility. But the gap shows the mechanism very clearly. The price used to bring in a new customer and the realized economics of the occupied building can be very different numbers. Current market data make that distinction especially important. In July 2026, Yardi Matrix reported that national advertised self-storage rents were down 1.6% from a year earlier. At the same time, Yardi's review of public operators' second quarter 2026 results showed a more mixed picture underneath the headline. Weighted average revenue growth was positive, occupancy was slightly higher, and in-place rent growth was positive even while advertised rates were still under pressure. Yardi also said that some of the occupancy improvement in 2026 was being helped by fewer move-outs rather than a broad surge in demand. Again, these are national and public operator observations. They do not tell us exactly what rent one facility in one neighborhood can charge, but they prove why the owner cannot manage the business with one number called rent. A facility can advertise a low move-in price to fill an empty unit. That can be rational because an empty unit produces nothing. Later, the operator may try to improve the economics of occupied space through in-place pricing, but there is no infinite pricing power. Customers can leave. Competitors can offer a cheaper alternative. Regulation can limit or complicate pricing practices. Reputation matters. And a local market ultimately has a demand curve. So the owner is constantly balancing two forms of leakage. Price too aggressively on move-in and the building may fill while the effective economics remain weak. Push existing rents too hard and the operator can create move-outs, reputational damage, or simply hand customers to a competitor. This is why the storage owner is not paid for occupied doors in the abstract. The owner is paid for occupied rentable space at effective rents that customers actually continue to pay. Once that money is collected, we finally have revenue. But revenue still is not profit. Return to our stabilized illustrative facility. 50,000 rentable square feet, 90% occupied. $20 of effective annual rent per occupied square foot. That gives us $900,000 of annual rental revenue. Now the property has to pay its own operating costs. Property taxes do not disappear because the business model is simple. Neither do insurance, repairs, security, utilities, marketing, and whatever payroll or management cost applies at the property level. For our model, we assume those property operating expenses total $300,000 a year. $900,000 of property revenue minus $300,000 of property operating expenses leaves $600,000 of net operating income, or NOI. That definition matters. NOI is the income left at the property after ordinary property operating expenses. It is not the owner's final profit. It is not cash after the mortgage. It is not cash after income taxes. And it does not automatically include every future capital expenditure the property may need. It is a property-level operating measure. Large public operators show why that line can be attractive in a mature storage portfolio. Extra Space's 2025 same-store results reported about $2.65 billion of rental revenue, about $764 million of operating expenses, and about $1.89 billion of NOI. Public Storage's 2025 same-store pool reported average occupancy of 92%, realized annual rental income per occupied square foot of $22.54, and a gross margin after indirect property operating costs of roughly 75%. Those are large, stabilized institutional portfolios. They are not templates for what a new independent facility should expect. In fact, that distinction is part of the point. A mature portfolio can show extremely efficient property-level economics because it is measuring a large collection of established assets under its own reporting definitions. Our owner is dealing with one property, one local market, one debt structure, and the painful path between opening and stabilization. So the only number we carry forward from our model is the $600,000 of illustrative NOI. Now we can ask the question that turns a good property into an owner-level investment problem. How much of that NOI survives the debt? Commercial real estate lenders often look at a measure called the Debt Service Coverage Ratio, or DSCR. The Office of the Comptroller of the Currency defines it very simply: net operating income divided by annual debt service. In plain English, how many dollars of property NOI are available for each dollar the property has to pay toward its debt in a year? Our representative facility has $4.5 million of illustrative debt. Assume a 7% interest rate and a 25-year amortization schedule. That produces annual debt service of roughly $382,000. Against $600,000 of stabilized NOI, the DSCR is about 1.57. After that debt service, roughly $218,000 remains before owner-level income taxes and before capital expenditures that sit outside our simplified property NOI model. That is a very different number from $600,000, and it shows why two owners can look at the same building and have different outcomes. The property can generate the same rent and the same NOI, but if one owner borrowed more, paid a higher rate, or structured the debt differently, the cash reaching the equity can change dramatically. Likewise, a slow lease-up is not only a revenue problem, it becomes a financing problem because debt service arrives on a schedule even when customers do not. This is why a self-storage property can be operationally healthy and still be disappointing to the owner who paid too much or financed it badly. The boxes do not know how the capital stack is structured. The owner's bank account does. But NOI has one more effect that makes this business especially interesting. It can help determine not only how much cash the property produces, but what the property itself may be worth. Income-producing real estate is often analyzed using capitalization rates. The basic idea is not complicated. If buyers in a particular market are willing to accept a certain yield on a stabilized income stream, then stabilized NOI can be capitalized into an indication of value. The OCC describes direct capitalization as a method that estimates value by capitalizing stabilized net operating income with an appropriate cap rate. In simplified form, that is NOI divided by the cap rate. The word stabilized matters. A property still deep in lease-up can require different analysis because today's NOI may not represent the income a buyer expects the asset to produce once it settles into normal operation. For our demonstration, and only for the arithmetic, assume a 6% capitalization rate. That is not a claim that 6% is a typical self-storage cap rate in 2026. It is just a fixed assumption so we can see the mechanism. Take our $600,000 of stabilized illustrative NOI and divide by 6%. The simple, direct cap indication is $10 million. Now the owner can see why small, recurring operating changes matter so much. An extra dollar of durable property income is not merely one more dollar this year. If a buyer believes that income is sustainable, it can also influence what the entire asset is worth. That does not mean every extra dollar of NOI automatically receives a fixed multiple. Cap rates move, buyer expectations move, interest rates move. Property quality, local growth, supply, operating history, and transaction conditions all matter. But the amplification mechanism is real. Improve durable NOI, and you can improve both current property income and the value buyers may assign to that income stream. That is the part of the model that makes self-storage look almost magical on a spreadsheet. Fill more space, improve effective rent, control expenses, grow NOI, increase value. There is just one problem. The spreadsheet does not create customers. The local market does. A storage building can be part of a national asset class, but the actual business is intensely local. The owner does not need every American household to want storage. The owner needs enough customers within a practical local trade area to choose this property at rents that support this property's capital structure. That is why two facilities can look almost identical and produce very different economics. One may sit in a demand pocket with limited competing supply and convenient access. Another may be only a few miles away but face three newer competitors, a less useful unit mix, worse visibility, or a wave of new construction coming into the same trade area. Yardi Matrix's 2026 reporting repeatedly shows that supply pressure is uneven. Some markets and submarkets are absorbing new inventory better than others. Recent deliveries have weighed more heavily on advertised rates in several Sunbelt and Florida markets, and concentrated deliveries can create pressure in a particular pocket, even when a broader metro looks acceptable. That local character is especially important in a fragmented industry. Extra Space describes American self-storage as fragmented, with large companies owning a minority of operating stores and many properties still controlled by smaller local operators. For a potential owner, that can sound encouraging because the business is not controlled by only a handful of chains. But fragmentation does not remove competition. It means the competitor set can be highly specific to one neighborhood. And this is where regulation becomes economics rather than paperwork. Zoning determines where new supply can be built. Property taxes affect the expense line. Consumer protection rules can affect pricing practices. State and local rules can shape the lien process when customers stop paying. None of these are side topics if they change the rent the property can collect, the costs it must pay, or the speed with which it can recover and re-rent space. Now return to our two nearly identical facilities. Facility A opened into a trade area where supply and demand were roughly balanced. Its lease-up took time, but customers arrived at rents close to the original model. Facility B opened after several nearby projects delivered new units. To attract customers, it has to compete harder on price. Maybe it still reaches high physical occupancy, but the effective rent comes in below what the owner underwrote. From the road, both properties can look healthy. Inside the income statement, they are no longer the same business. So let us make that difference small, not a catastrophe, no fire. No recession-proof claim suddenly failing. No empty ghost property, just a 10% miss on effective rent. Our stabilized base case has 90% occupancy and $20 of effective annual rent per occupied square foot. That produces $900,000 of rental revenue, and, after our assumed $300,000 of property operating expenses, $600,000 of NOI. Now, leave occupancy at 90%. Nothing changes visually. The same number of doors are occupied, but lower the effective annual rent by 10%, from $20 to $18 per occupied square foot. Rental revenue falls from $900,000 to $810,000. With the same $300,000 of illustrative operating expenses, NOI falls from $600,000 to $510,000. The annual debt service has not changed. It is still roughly $382,000. So the DSCR falls from about 1.57 to about 1.34. And the cash remaining before owner-level taxes and capital expenditures falls from roughly $218,000 to roughly $128,000. That is a $90,000 rent miss, but the owner feels it much more sharply because debt service is fixed in our example. Now look at the valuation mechanism. If, purely for the arithmetic, we hold our illustrative 6% cap rate constant, $510,000 of NOI produces a simple, direct cap indication of $8.5 million instead of $10 million. A 10% miss in effective rent has reduced annual owner cash substantially and, under the same illustrative cap rate assumption, reduced the value indication by $1.5 million. That is not a forecast of what would happen in a real transaction. In a real weakening market, the cap rate itself might also change. Buyers might demand a different yield. Financing conditions could move. The local outlook could change. The point is not the exact sale price. The point is causal leverage. When a recurring property income stream sits above fixed debt and also feeds into how the asset is valued, a modest operating miss can travel through several layers of the owner's economics at once. And nothing about the building has to look broken. The gate can open every morning. The cameras can work. 90% of the rentable space can be occupied. The original underwriting can still be wrong. That is why the most dangerous failure in self-storage is often not dramatic. It is normal looking. So is self-storage passive income? The mechanics give a better answer than the slogan does. The physical operation can be lean. A facility can use automation for rentals, access, payments, and routine customer interactions. It does not need the staffing intensity of many service businesses. But low-touch operation does not make the economics automatic. The owner is still exposed to the site that was chosen, the price paid, the amount borrowed, the speed of lease-up, the rents customers will accept, the rents competitors advertise, property taxes, insurance, repairs, security, regulation, and the possibility that somebody builds more supply nearby. The same caution applies to another popular description of storage, recession-proof. The evidence does not support that wording. Extra Space's own risk disclosures say its results can be affected by unemployment, interest rates, housing market transaction volume, recessions, local supply, and other economic conditions. The company also discusses historical resilience, but resilience is not immunity. A boring building is still exposed to the economy around it. What makes storage distinctive is not that the owner escapes business risk. It is that so much of the risk is concentrated into a relatively small set of numbers. How much rentable space exists? How much of it is occupied? What effective rent is actually being collected? How much does the property cost to operate? How much debt must the NOI support? And how durable is that NOI in this local market? Those questions are less glamorous than a startup pitch. They are also the business. Go back to the row of storage doors from the beginning. At first, they looked like the product. Build the boxes, put up the gate, collect the rent. But now every door represents something more precise. An empty door is unused productive capacity. An occupied door matters only at the effective rent the property actually collects. The combined rent from all those doors has to pay the property's operating expenses before it becomes NOI. The NOI has to support the debt before cash reaches the owner's equity. And if that NOI is durable, it can influence what another buyer may be willing to pay for the entire property. That is how two facilities made from similar concrete, steel, and roll-up doors can become completely different businesses. The difference is not the box. It is the match between local demand, effective rent, occupancy, operating cost, debt, and time. Self-storage can be an extraordinarily efficient real estate operating model precisely because the physical product is simple. But simplicity does not remove the difficult parts of the business. It concentrates them. The owner does not win because the boxes are boring. The owner wins only when those boring boxes fill in the right market, at a sustainable price, quickly enough and profitably enough to justify the capital tied up in them.